Ertan, please.
Thank you so much. Can you hear me? Yes, I think you. Thank you. Nothing to clap yet, but hopefully in 10 minutes. So I'm the founder of Multiple Capital. Very quickly about us, Multiple is a fund of funds. So we invest in other VC funds. And I'm doing this now for 12 years, investing into VC funds and investing into micro VCs, what we call micro VCs. So I'd like to start with these provocative questions. Why micro VCs? I'm getting this for 12 years from potential investors. Ertan, why micro VCs? So I think most LPs overlook the potential to invest in micro VCs. And I don't see my slides here, by the way. I don't know why. Is that... Okay, it's just there. Sorry. So most LPs overlook the highest performing segment of VC funds. So we think micro VCs are that highest performing segment of the VC world. And I think we have to change that slowly, unfortunately, but at some point. So what is the challenge? What is the common misperception about micro VCs? I think there are three myths. Myth one is small funds can't deliver big returns. Reality is that 75% of all VC funds returning 3 times money, so 3 times your capital, were small funds. So 3 out of 4 returning what everyone expects in that ecosystem, 3 times money, were small funds. There is the second myth that emerging managers have high risk. And here again, this chart probably known by several of you working in the VC ecosystem. It's a PitchBook data set renewed every year, but it's like showing for a long periods from 2004 until 2016, the top 10 performing VC funds. And green, in our case, means small funds. And here again, if you look at emerging managers, it seems that the majority of the top performing funds over a long period of time were emerging managers. And again, we think emerging managers is just half the truth. Emerging managers most of the time are small VC funds. So the reason why they are outperforming is not because they're emerging. The reason why they are outperforming is mainly because they're small. And the third myth is, larger funds have better exit opportunities. Large exits, larger funds, etc. So we just picked here a data set of exit valuations globally of VC-backed companies by Crunchbase. And the average exit valuation globally, including the US, including Europe and everywhere else, is 87 million. So this, by the way, we're doing this for now 6 or 7 years, the same chart, and it is always around 100 million. So 100 million is like the number that you have to remember. Currently, it's 87, but around 100 million is the exit valuations for venture-backed companies. So every venture-backed company has to live with an exit valuation of 100 million, or in this case, currently around 80 to 90 million. So if you are a very big fund, those exits will not achieve anything for you. But for a small fund, this kind of exit is still very returning. It's very, very, very meaningful. So let's talk about why micro VCs win, and let's talk about that topic, alignment of interest. I think it's probably one of the most important when it comes to explaining why small funds have a higher chance of being or returning more. So I think I just gave a very, very quick example. Sorry for the not nice formatting and everything, but I just compared 2 funds, a typical micro VC fund of 25 million in fund size, and a typical established firm with 500 million AUM. So, and I just made very simply, the typical management fees for a small fund would be 500,000 per year, and I assumed they have like 5 employees, and that equals to 100,000 per year per person. And in an established firm, they're like, in this case, 10 million management fees per year, and I assumed they have 20 employees and not 5. And that would equal to 500K per person. So I think this is one of the core differences between a micro VC in terms of alignment with their LPs, with their investors, and an established firm. And don't forget, many of the established firms manage billions today. So it's not 500 million. It was just an example. If you take one of the more established in the Nordics, some of them have 2 billion under management. That equals more like 20 to 30 million management fees every year without returning money. So why micro VCs then, or why is the alignment of micro VCs better for LPs? I think one is they invest at the earliest stage and only at the earliest stage, which means it's the highest multiple. If you invest at the seed stage and you exit at 90 million exit valuation, then there's still a high multiple. If you invest at a Series A or Series B or Series C, the multiples get smaller because you enter at a higher price point. So we think that investing only or mostly at the earliest stage equals to the highest potential multiple if you have the right companies in your portfolio. Second, they have very low management fees. Again, what does that mean? They have a focus on carry. I don't know if every one of you know what carry is, but that's like the profit sharing, in a VC fund. So they're focused on returns rather than management fees because they don't get rich by management fees. And the third point is they have to need to prove the first fund. I'm again talking here, micro VCs equaling emerging managers because many of the small funds, micro VCs, are emerging managers. So what happens is those emerging managers have to prove that they are good managers for the future. And so I use the word hustle mode or hustling. They're real hustlers when it comes to, or comparing to the typical established firms with tens of people and where the management fee is already like significant enough. So the hustling mode is not there anymore in many cases. So what is the cost of ignoring micro VC? It's very, very hard to return large funds. This is an example of Kaufman Fellows. It's a US organization. They've invested here in 95 VC funds, and that's their own portfolio. It's an older set, so you can find newer sets, and I think if someone is interested in the newest data or very, very current data, you can go on the CalPERS website. CalPERS is one of the largest Californian pension funds, and you find they make it public how much the funds return they invested in. So it's much better, but it would be too complicated to explain here. Well, what it says here is, what they are saying is all of the larger funds, in their case, all of the 1 billion plus funds were not able to return 2 times the money net of fees. Most of them are not returning 2 times money net of fees. That's the red line. They're all below the red line. The only ones returning more, so 2x, 3x, 5x, in some cases even 6 or 8x, were the smaller end. Now you could argue, well, Kaufman was probably not a good picker, right? But isn't it interesting that they are not a good picker at the large funds, but very good pickers at the small funds? So and you have like hundreds of these kind of data sets where it's always showing very, very similar results. The returns just decrease by fund size. The larger the funds get, the harder it is to return a VC fund or a fund in venture capital. And it seems data-wise, the smaller fund is, the higher the potential or the probability to have higher returns. So what are the to-dos? What are the takeaways from these from this short presentation? I think there are 5 do's for allocating to micro VCs. First, diversify across multiple micro VCs. So it's not enough to invest in one micro VC in Gothenburg, for example, right? Second, to focus on multiple GPs. So not investing again and again into the same GP, several funds, but across GPs with strong networks and niche expertise. To prioritize funds under 100 million. So we are even focused on funds under 50 million, but I think as a general recommendation, funds under 100 million have probably a higher potential to be in that bucket to benefit most of in the venture ecosystem. To ensure GPs have aligned incentives, so don't back firms that are huge and then raise a small VC firm on top. So you have like these 1 billion AUM firms, we get these emails all the time, and then they say, Ertan, but now we have a small seed fund for this specific area, which is a 50 million fund. That just increases their AUM from 1 billion to 1 billion 50. So it doesn't really help in terms of aligning the firm with you as an LP. And last thing, I think the competition in our area now slightly increases, so it's getting more difficult to get into the right funds. That was not the case 5 to 10 years ago. It was very, very easy to get into the right funds if you found or had a conviction. It's getting more difficult. So I think everyone who wants to benefit from that micro VC world has to start building, and that's the next thing. If it comes up, yeah. If you want to execute a successful strategy on how to invest, I think again, you need to build something like, we call it organizational committee or whatever, I would say team. Yeah, so team of 1 or 2 person that are truly focused on selecting funds, because that's the second most important thing. Selecting managers is super important. We're looking at hundreds of funds every year. There are hundreds of funds coming into the market every year, so it's not easy to pick a few of them. Diversified allocation across sectors, geographies, and vintages. So means not only 1 year investing, but investing over several. A vintage is a year in VC language. So investing over several years in several geographies and sectors. And then, of course, as all of you probably here understand and know, it's an illiquid asset class, so you have to wait and think very, very long term. But long term, I think it's almost a given that this is an outlier asset class. And the last thing is commitment to emerging managers. Emerging managers equal most of the time to micro VCs, and you have this hustle mode or the right alignment between you as an LP and the funds. That's it, more or less. If you have any questions, I'm here all day. Happy to talk in the next breaks. Thank you very much.